No, any questions? No? Exam questions?
Nope.
No? Come on, I see it in some of your faces, you got some questions. We're gonna post something about the essay questions, don't worry.
Okay, did y'all give feedback on the stuff before we go?
You can go back and look at the test.
Okay, well, yeah, I'm gonna have to.
Yeah.
Some of, and here's how I grade, okay? So limited time, so I don't, so just so you know, I don't look at your names when I don't know whose paper I'm grading. So I just hit next student and grade the paper, okay? A lot of people are like, you're so much harder on so-and-so. I'm like, well, first of all, why are you guys comparing grades? Everybody compares grades, right? But I don't know whose paper I'm grading until after I check the final grades and go, oh man, well, some of them need a little help. I will go ahead and say this. I was pretty generous on the essay questions, but I will tell you, when an essay question is 20 points, okay, and there's 3 essay questions totaling 60 points of a 120-point exam, 3 sentences do not make an answer. 3 sentences in a paragraph don't make an answer, okay? If you have 3 paragraphs and there's 3 sentences in each paragraph, that's a really good starter for an essay, but it is not an answer, okay? That's the whole point of this, is 20 points, give me something, okay? When it says list, and then explain. If it doesn't say list, don't write me a list, okay? If it doesn't ask for a list, don't give me a list. I'm looking for an essay, because here's what this is prepping you for. This is prepping you for being able to write papers, okay? You're gonna need to have really a lot of information to write a paper, okay? This is grad school. I hate it for you. I've been there. My master's thesis was 158 pages. So I have no sympathy for you, okay? And that doesn't include the research. That's just the written portion, okay? So when I look at an essay and I go, okay, I expect, I expect, thick paragraphs. And, I know it's got that, it looks like it's a little tiny thin answer. But man, when I put it up on my screen and those 3 sentences equal 1.5 lines, I'm like, seriously, you couldn't expound a little more on this? I mean, half the stuff is not, and then I get answers that are fluff. I can see through fluff, guys. I mean, fluff is fluff. I don't wanna, like a question, let me give you an example. Last year, we talked a lot about the Affordable Care Act, and I had a student who wrote something to the effect of, the Affordable Care Act is now the law of the land. I'm like, this is 2017 last year, I'm like, it's been the law of the land now for 7 years. That is not a good starter sentence, okay? And then I went on to say, there have been many changes in our healthcare because of the Affordable Care Act. I'm like, okay, that's not telling me anything. And then it says, those changes have been hard to maneuver, and then they then they made a list. Didn't ask for a list. Gave me a list of like 3 little bullet points of why it was difficult to maneuver. End of discussion. And I'm looking at that, I'm like, okay, well, that's a 20-point question. I'll give you 5 points because you gave me 5 points. Got it? Make sense? All right, I'm not being overly critical, but I'm just giving you the expectation. Some of you I gave points to, and I was like, man, I'm so glad this is the first exam because it'll be much easier to grade the next few. Because it's really, for me, when I see a short one, it's really easy to grade because I go, okay, well, I see 3 or 4 points on there. That's all I'm giving them, 3 or 4 points. And 3 out of 20, that'll tank an exam grade, okay? So fortunately, nobody in here got a 3 out of 20 on an essay, okay? I think the lowest I graded somebody was like a 10 out of 20. Okay, I was pretty generous with them. So don't take it personal. I get all that happens, and I'm like, this is not personal. This is to help you know how to write an essay. Okay, Dr. Beatty and I are not the toughest when it comes to grading essays. Okay, so give us some information. We'll help you along, but we're trying to help you so that when you do get to some of the professors that are a little more difficult, it won't be so bad. Okay. other non-questions that you have that I can answer? And yes, I'm hiding behind the podium because this thing exploded on me a little while ago, so until my pants dry out, I'm sticking around back here. Yeah, I'm like a 12-year-old, so. Let's see what else came up. Excusing Dr. Beatty, she's out today. I think she's traveling to a conference or is leaving a conference. I don't know, I don't ask. She doesn't ask me what I do. I don't ask her what she does. We just work together. So. But yeah, she's gone. So you're stuck with only me. So if you have questions I can't answer, I will write them down and I will look them up and I will get it back to you within a week and a half, okay? Sometimes it takes me, I have to do research too. Yeah, sometimes I think students think that, we teach it, but we don't know every little detail, especially when it comes to finance. With as much as healthcare finance has changed, it's hard to maneuver. So I can't know every little detail. In fact, I had to update the slides for today 3 or 4 times because I found information in there that had changed just from last year. One of those slides was the Medicare slide you'll see towards the end. There's a link. That's why I'm not going to go into every finite detail of Medicare and the 4 different parts because the document, there's a PDF document associated with it that will explain everything that you should be really familiar with, because this is what you use to familiarize patients with when this is what's accessible to them. It goes through all the details. All the page numbers were wrong. They updated almost every 2 to 3 years. Well, the last 3 years they've updated every year because you get Affordable Care Act changed a bunch of stuff for Medicare by year. And then, President Trump comes in and he's like, no, we're not going to fund that portion of the Affordable Care Act. So it's no longer applicable. So they had to make changes, and so I had to make changes. So, let's see, what else? I think that's it. Sure, you got no other questions about the exam? For the most part, everybody did really well. Next week, I think I'll talk to Dr. Beatty. We'll see if we can put a synopsis and show everybody kind of the range of grades. I like to do that. I don't know how you like it. I guess it depends on what part of the range you're on. I had a chemistry professor in my undergrad who everybody hated, and I didn't care for him either. But he would get up and say, we had this many students score in the 60s, 70s, 80s, and 90s, and we had this many score in the 20s, 30s, 40s. He'd divide them up, and you could see people sliding down in their seats as they were the 20s and 30s. So I've not had, I won't say I haven't had any, but I have not had many in the last 5 years who have scored in the 20s and 30s on the exam. That's one of the great things about a multiple choice exam, right? To be honest, if you're missing that many where you're getting 20s and 30s on your exam, on a multiple choice exam, you might want to reconsider your educational opportunities, right? So grad school is a lot different than undergrad. There's a higher expectation, and the students really expect a lot more than we do. So it's pretty good. So, all right. Well, let's dive in to today. We're going to talk about finance, everybody's favorite subject. Probably one of the more controversial portions of healthcare, just because of the number of payer sources and the different laws that are on the books. So we're gonna go through some of this. So it's pretty complex, right? Anybody had a medical bill in their lifetime? Yes, no. By the way, I thank you guys for putting your little names out there. Tell you a funny story that happened in orientation. So I'm sitting there in orientation, and almost everybody has their little name tag on, literal, like Quillen Rehabilitation Hospital. This is my name. This is my job, right? And look at this one lady, and I'm like, she looks kind of familiar. And I'm like, okay, this is probably one of those things. We go through and we're talking. I spent an hour with them, literally closer than we are, and always ask everybody to tell me, one unique thing about themselves, unless they want to give more, and go around the room, and there's some really funny stuff. And then this lady starts talking about her family and told me her name. And I'm like, I can't put my finger on it, right? So I just act like no big deal. Well, Tuesday night, I'm in a board meeting, and one of my friends that I acquainted, really, really strong acquaintance. Like we'd go to lunch together, all this stuff. But I'm sitting there with him. He's like, "Yeah, my wife said she was in orientation with you the other day." I said, "Your wife was in orientation?" He goes, "Yeah, I've known him for 5 years." Okay, and he's like, "Yeah." I was like, "What was she doing in orientation? Did she swing by to drop something off or something?" He goes, "No, she was in orientation." I said, "What?" He's like, "Yeah, Melanie was in orientation. She started work there." I said, "Wait a second. What is she doing?" She's a PT. I'm like, "You gotta be kidding me." So, yeah, I'm bad with names. So that's all this is to tell you. I'm really bad with names. I felt really horrible. I went in there today and I saw her and I said, "Look, so sorry." She said, "Yeah, I thought it was pretty funny. I got home." She goes, "I was trying to drop some hints. They have 4 kids. We have 4 kids. All these." I'm like, "Oh, that's really cool. You got 4 kids."
You should have just went in there the next week and just played it off.
I thought about it. I was going to have our therapy director send her up and ask her if she would finally introduce herself to me. But later. Anyway, so thank you. I will forget your names. If I'm giving a lecture, just bring those back, and that'll be great. So then I can look out there and you're like, "Oh man, he knows my name." You'll forget that you have that there. I'll feel a lot smarter. So anyway, all right. So complex system, kind of like my complex lectures, right? So if you think about if we have such a complex system, why do we have all this overlap? We have tons of insurance overlap, right? We have a lot of differences in financing, and we have some changes that were attempted because of the Affordable Care Act. Okay? All right. The definition of an uninsured is people, it seems pretty obvious, right? People not covered by either private or government health insurance. Is there a pretty good sized population of those in our country? Yeah, there's fairly good size of those people, right? A lot of things we'll talk about today. We'll talk about why we have people like that, and a lot of it has to do with state politics, federal politics, and personal choice. Okay, and we do have a voluntary system, which doesn't make it easier, right? We have a voluntary system. When you can force people to do things, it's easier to get higher percentages. Employees are not required to join, even though your employers are the largest provider, largest supplier, I guess. They are the ones, they're not providing it, but they're the ones that get the contract and provide you the insurance. They're the largest percentage of all plans are through your employer, right? So if that's the case, you still don't have to buy into your employer's health insurance. And our government has only a select few, and it changes. It seems like that changes every year, doesn't it? How many people are going to be covered? So, and it varies, like I said, by state. So that's also a different dynamic, right? All right. We have about, 36, 35 slides to go through. And it is probably the prettiest day we've had this year. Fortunately, the sun will be down by the time we get done, but we'll get you out close to that time, okay? Maybe you get a nice sunset tonight, right? Dr. Beatty's not here to hear this, so I can get it through. Don't wrap me out. I'm being recorded, so that doesn't help.
You won't know.
Yeah, you will. So, just remember, I'm the favorite. That's all you gotta do. I'm kidding. That's what I tell my kids. I'm like, remember, I'm the favorite. Your mom's the one. And she's like, I heard that. I'm kidding.
She's like
Or you have to sleep
down.
outside.
And My kids know that I'm the mean one, so that's why they're always going to mom for a better deal, which she doesn't ever give them a better deal. So my wife and I are pretty much joined at the hip. Can you imagine? I mean, the same type of attitude coming out of someone married to me. I mean, it's just like those poor kids, you know, like, poor guys and daughter. Sheesh.
Guys and
They've got it made. They've got it made.
daughter, child.
Yeah, I'm trying. Yeah.
Guys and daughter.
All right, so pretty simple, right? As far as the role and scope of health services, financing pays for premiums. Anybody not aware that premiums have to be financed? Seems like a pretty self-explanatory thing, but you know what's really funny about that is, what are the financing options? Can you give me a few? How do you finance your health care? My kids finance it through me, right? I'm there, and I get it through my employer.
So, for, I guess, people that go through their employer, a lot of times they'll pay a certain amount and the employer will match that or whatever the case may be, so.
Yeah, so we're talking about fringe, right? Fringe benefits type thing. Yeah, and we'll jump into that. I'll tell you a funny story about that later because I'm going through some contract negotiations right now. And one of the contracts that we have, they pass on almost all of their expenses to us. Like I can see them. And I was looking at their fringe and I'm like, holy smokes. Maybe we should consider bringing this in-house because their fringe is expensive. So yeah, what about charity in the United States? Is that a big deal for us to have charity pay for as a financial means for people? Yeah, it's a big part of it. In fact, the federal government expects a certain level of charity, and some of this charity can not only be written off as charity, but you can write it off as bad debt. And we'll talk a little bit about bad debt. Pretty extraordinary. I wish I could handle those people that owe me money. I wish I could just handle that the same way that hospitals can. There's some benefit there. How about insurance increasing demand? All right, that's a pretty interesting concept, right? Demand goes up if you have insurance. Kind of seems
More accessibility.
Yeah, so it's based on accessibility, right? And insurance lowers out-of-pocket costs. Okay, so everybody always looks at that and go, how is insurance lowering your out-of-pocket costs? We're all talking about how nobody can afford it. But the fact of the matter is, it's expensive to have healthcare procedures done, right? The other side of that is patients consume more. We're going to talk about moral hazard, right? If you listen to one thing from this lecture and you want to talk about an essay, if you include moral hazard in there somewhere, that would be really, really helpful to you. Okay, I'm just going to throw that out there. Okay. See, Dr. Beatty doesn't do this kind of stuff. But study it. Moral hazard's a big, big thing for an individual. Understanding the whole idea behind how if I have it, I'm going to use it. But if I increase the skin in the game that I have, I may not use it as much. So we have different methods to control that, right? Or we try to control that. Financing also looks at supply side factors. Remember we talked about supply side rationing, how that happens? I talked about that, I think, last week. We don't like that in the United States. We feel like it quells innovation somewhat. If there are financial resources, then sometimes we change the model of our organization in order to make sure that we're maximizing our reimbursement. So for example, we have hospitals have all adopted a prospective payment system type model now. They're looking at what they can make. They look at what the patient's codes are like for billing and determine what the best way to code things are. They look at the chart specifically and say, okay, how am I going to get the best bang for my buck? You know, they're looking at the total minutes being spent with a patient now to make sure that they're getting reimbursed enough. you know, for example, within a nursing home, when nursing home rugs changed a few years ago, I think they went to rug 4. Some of the changes that occurred with additional through the years with that. Everybody know what rugs are, by the way? So it's a resource utilization group, and that's the only way that nursing homes get reimbursed, okay? They don't use CPT codes, not worried about DRGs. They look at resource utilization groups, and those are based on total minutes, okay? So used to, you could do a lot of group therapy. So you'd have 3 or 4 people in there, 3 or 4 people are in the room, and they're all getting 40 minutes of therapy. But there's only one therapist working with 3 or 4 people. And so federal government says, you know what, they may be getting that, but they're not getting individualized care. So we're gonna make you divide those minutes by the total number of patients that are in there with you. And so you spend 40 minutes with 4 people, they only can bill for 10 minutes. So what does that do for you? You're like, why would I do that? Why would I even do group therapy? I'm not getting reimbursed for it. So I'm just gonna add another therapist, let those 4 patients get more minutes. I can bill for more minutes, I can get more money. So we'll talk a little more about that. So that changes your structure as well though, right? That kind of thing changes your structure. Adding more staff also may lead to shortages in different types of staff members, because now you're looking at billing based on a one-on-one versus, you know, a 4-to-1 ratio. So now I've developed a shortage because I need more PTs, I need more OTs. Okay, so lots of downstream changes and effects. Okay, make sure I'm not missing any details. All right, then you got what they call the wonderful RBRVSs that tell physicians how they can bill. Somebody from Griffin, Georgia is trying to get me. So think about, everybody in here knows how to calculate the RBRVSs, right? Okay, good, because I'm going to show you how. So this is the generic idea behind working with physicians fee for service, okay? And if you look at these first 3 categories, 3 areas that are added up, you'll see that within that first area, you're looking at the relative time for providing a service. So it's talking about time, and then it's going to talk about the cost of practice, and then it's going to talk about malpractice insurance, okay? And then those are multiplied by a dollar amount, okay? Currently, the state of Tennessee, those rates, those numbers, so your RVU would be, I believe it's a 1.0, and then you add that number to your practice expense, which is a 0.9, and you add that to your what they call a PLI, which is your physician liability insurance rate, and that's a 0.525. That's what the government has allowed for the state of Tennessee. It's funny, some states have it broken down by county, some of them have city rates, but the state of Tennessee has one relative number, okay? And then that number is multiplied out times whatever you are allowed to get reimbursed, okay? Now you have to consider also that some of these, you're looking at your practice expense, some of that may vary, depending on the type of service, you gotta equate that in there. It's not just a generic number, okay? And so that's just a general idea to get you where you want. Right now, the federal government allows $35.88, 89 cents basically after you move down the scale. Okay, and that's supposed to move, it's proposed that it'll go to $35.99 this year. So it's not moving a whole lot, right? That $35, $36 roughly, times whatever the expenses are. So that's a generic way to just look at how physicians get reimbursed on the physician level. Okay, that's in practice. Okay, and I put the link down there on the bottom. It gives you a little bit of a schedule, fee schedule idea. You can check that out. So cost controls. If you're looking at how to control cost, you're going to look at basically you want to determine what your costs are, right? So how do you determine your total expenditures? Super easy. It's your payment times your utilization, okay? And that's how you get your expenditures. We try to overcomplicate it, but really it just comes down to payment times utilization. So what that tells us is whatever the insurance is going to pay, that you multiply that times how often you use that service, and that tells you what your expenditure is. Pretty simple, right? Seems like it. So they put this really ridiculous figure up here so that it'll get you completely confused. But if you'll see the key parts of this, your payment controls a lot of things, right? The supply, and it feeds directly into your expenditures. Insurance controls payment, right? It also can control demand because it can say to you, you really don't need that procedure. We're not going to cover that. I had an experience today where I overheard our controller having a rather heated debate with someone who was objecting to the bill they received in the mail, and the explanation coming out was it should have been covered in full. And we're like, we have no control over what's covered. If you agree to a service, you should check prior to having the service done. That's between you and your insurance company. We still bill based on, if you don't pay, that's up to you, but we still bill you for the services that we provided that you said you wanted. If your insurance company makes that an optional service for you, it's kind of like when I go to the dentist. I always opt for nitrous oxide because I'm that guy. I think, why not relax? And anyway, my wife says it's your only opportunity that you have ever taken to get high. So that's not true. I'm just kidding, it is true. So everybody's like, what? This is coming from
Just for a cleaning?
No, not for
Okay, it was like,
if I have to have major
that
dental,
option?
if they do some major dental work, I had a crown put on a little while ago, so I'm like, yeah, heck yeah, I'll spend $30 my own money for nitrous. I'm not an idiot,
Oh, yeah.
Yeah, so
Wisdom teeth.
yeah. By the way, that comment comes from a guy who's never had a single sip of alcohol, so you can imagine. Everybody always looks at me with the same face when I say that. Okay, 43 years old, never had alcohol. I figure I'm not starting now at this point, right? So just total anomaly, right? I don't even drink coffee. Go figure, right?
And
So
What do you know?
what? Isn't that insane?
What you did? You
Yeah.
have to have one.
I don't like coffee.
Tangent City, right?
Yeah.
All right, so, but this is how you determine expenditures, right? So basically, think about all the things that insurance can do, right? If it's not covered, though, does somebody pay for it? Yeah, somebody's got to pay for it, right?
Mhm.
Funny thing about payments, right? And charges, and I've got a slide on this somewhere in here, so we'll skip it because I'm gonna go ahead and jump into it. As the supply side, as a hospital or as a physician, you seriously can say, well, this procedure is going to cost you whatever you say you want to bill for it. Okay, The difference is insurance, Medicare, and all of those other payer sources are gonna say, you're crazy, we're not paying that. And so what are you gonna get reimbursed? Only what they say they're going to pay, right? Now, if I say that a procedure, I'm gonna charge 10 grand for a procedure, and Medicare says they're only willing to reimburse $5,000, can I legally charge the patient for the extra 5 grand? It's double-sided, okay? So you have to think about this. Yes and no. If there's precedence for that charge, I can charge the patient for it. If there's no precedence, then the chances are I'm never gonna see a penny of it. And Medicare is gonna look at me as having fraudulent charges, okay? Because Medicare, based on rates, they can say we have a history for this CPT or this DRG, and this is all we think this is gonna work. This is all you're gonna make off of, period. Okay. And so sometimes people think, for example, you go to the doctor and they say, well, this test cost us, whatever, and you think, well, that's outrageous. Insurance only pays 80%, you're stuck with 20%. Those rates are pretty much set in stone. Physicians not going to go out and say, we're gonna charge you 10 times what the normal rate is, because they know they're never gonna get it, and they're never going to be able to justify those expenses. And the IRS is gonna walk in there and go, what the heck? Nobody else charges this much. It's not, we're not gonna let you write off this much in bad debt or write this much off in charity work. So there's all these little things. Technically, yes, you can charge it. You're not gonna get anything out of it, okay? So the other side of this is if Medicare is the largest payer source, what do you think insurance companies do with their payments? If Medicare is determining how much they're gonna pay for something, what do insurance companies? What would you do if you were an insurance?
They don't wanna pay any more than what.
Yeah, why would you,
Medicare
right?
has to pay.
I'm looking at that going, I'm not gonna pay that. In fact, I'm gonna cut it by 10%, because these people, it'll keep our costs down. And so a lot of times insurance companies pay less than what Medicare does. In fact, when I was running nursing homes, if I had a Medicare patient come through, which was a lot, I was happy. If I had to deal with insurance, there's so many more hoops I had to jump through with insurance. So I really, really like Medicare patients, because Medicare patients, first of all, you're gonna get paid, you're not gonna have to fight for anything, and you already know what the pre-established co-pays are for the most part, depending on the patient, of course. But I mean, it's pretty incredible. Medicare is the way to go. So think about that. All right. Let's go on in over here. So if we have increasing cost controls and we also have increasing expenditures, what gives? So your cost controls are increasing, trying to keep the cost down, but your expenses are going up. Physician expenses, hospital expenses are going up. How does anybody make any money? How does anybody come out up on top? There's no direct answer here. I'm just asking for your input. I want you to think about this one. This is a hard topic for a lot of people, because there's a lot can happen here. So how do you fix this problem if you're running a hospital? You got to cut your expenditures, right? So what are you doing? What are some of the things you're doing?
Cutting staff,
Okay.
cutting
Looking at,
underused services, I
looking
guess.
at like processes and see.
Yeah. So cutting staff, looking at your services, you're looking at all your processes. Those are actually the top 3, okay, in my book. If I'm looking, the first thing that I'm looking at is I'm determining what is safe, what are safe staffing levels, okay? Some states mandate a certain number of staff be in place depending on the type of organization you are. And so most organizations look at that, the state dictates a minimum number of staffing. And so a lot of places go, minimum number of staffing, check, that's all I need, right? Because that's what we do in the United States, right? Somebody sets the bar low enough, we're like, yeah, I can achieve that, right? And why would I go above and beyond when I'm not gonna get paid any extra, right? I'm gonna get paid if I keep this. That's what we do. It's like I said, you wanna find the easiest way to get something done, you find the laziest person in the room and give them the assignment, and it gets done the fastest, right? It's not done right all the time, but it gets done the fastest. So that's why I say you get a group of really efficient people and then really lazy people and make them work together. And then you usually turn out with a decent process. Because lazy people are like, I don't want to do it that way. No, that's too much work. All right, so one thing that happens is insurance gets involved, okay? They say we can control your expenditures. Isn't that wild? Can you imagine running a business like this? So say you're running you're running a donut shop, because I gotta go get donuts after I leave here. So you're running a donut shop. Can you imagine say you got donut insurance, right? You got people coming in to buy your donuts and they're gonna pop out their card, but their insurance card says, we're only willing to pay, $4 for a dozen of regular glazed. And you're like, well, I guess that's what your plan's gonna pay,
God, it costs.
Yeah.
3 of them from Dunkin'. Krispy Kreme costs like $3 or $4.
Yeah, that's my point. Okay, but the insurance, that's all they're paying, and you're on contract. You got a contract with them, right?
I know this.
Yeah.
Sorry.
So, insurance controls a lot of those expenditures because you're saying, okay, well, if they're only going to pay that, I'm going to thin my glaze on my donut, right? I'm going to thin my glaze. I might use a lesser quality yeast. I might make smaller donuts. Yeah, just a little bit smaller. Yeah.
Those donut holes were invented.
Exactly. And there's your donut hole. Exactly. So think about it that way. That's what happens, right? You're looking for cheaper alternatives. So we went through this big phase with healthcare where we looking for cheaper alternatives, and sure enough, we found cheaper alternatives, but our outcomes were so horrible that all of a sudden we realized it was costing us more money on the back end. So a lot of people were coming back and saying, you're cheating me on my donuts. I want you to give me another dozen because those are way smaller, okay, than you guaranteed me. Okay, so say you got a guarantee that each donut's gonna weigh 2 ounces, but you're running at 1.85 ounces a piece in hopes that they're not gonna weigh every donut, right? And so they come back and they're like, hey, you owe me this much in donut weight. So then you got to start production back up, right? And that has a big cost. So now, same thing with healthcare. You got to bring these people back in. They never got fully well. They come back into your hospital and everybody's paying for it. And the insurance company's like, dang, I got to pay for this again? And then they go, no, we're not going to pay for this again because now we have what we call bundled payments, right? We're under that bundled payment system and we're under a fee-for-service system. And we have all these other systems that some people buy into and others don't buy into. And you're just like, well, which one are we now? And it's really confusing, right? So you get the bucket of money now, right? We want a bucket of money and we're trying to filter it out. And if they come back, I got to still pay for it out of this bucket of money. Make sense? So insurance function, you have different parts, and you're looking at your risk. When you talk about an insurer, that's the ones that do the underwriting. They're the ones that determine who they can insure, right? And then the beneficiary, that would be you, if you are the one that's insured, right? And then premium sharing. What is premium sharing? I love this part. Everybody makes eye contact till I ask a question, and then everybody's looking at their shoes.
Maybe sharing opinion between employers and their employees.
So you think about think about how risk works, okay? Let me walk you through risk, okay? Just from an insurance standpoint. So let's say we want to insure, say I'm setting up a premium and I have 4 of you, okay, that are going to be insured. And it's going to cost, in order for us to insure you, we know that it's going to have a minimum cost per year to provide services, okay? And when I look at that, I'm like, gosh, you guys start thinking about this. You're like, man, if we had more of us, we could spread this out across more people, and so our premiums would become lower, right? So this is what insurance companies do, okay? They look at the big demographic thing, right? You know, when you fill out your insurance information, they want to know everything about you, okay? They call it, what is it? Demographics, right? Really? It cracks me up, you know? Think about if you were to select friends based this way, you know? Okay, I want 12 friends. I need to meet certain demographics because it's safer for me, right? What would that, you know, what would you call that, right? Nobody does this. Insurance companies do it all the time, right? They're like, okay, I'm gonna, what they call my risk pool. And they say, okay, in our population, Johnson City, we have this many Caucasians, we have this many Asians. They name off every demographic they can. They look at the ages. They look at the types of illness that associate with these ages and these demographics. And they say, it's going to cost us this much to insure these people, okay? And so they determine what the risk is. And then based on that, they say, okay, here's your premium. Good example of that was I left one company in Chattanooga, Tennessee to go work for another company in Arkansas. And the one in Arkansas was a brand new startup company. The one in Chattanooga had been around for at least 15 years. Now, both of them, the one in Chattanooga had probably, gosh, they probably had 12 more facilities than the other one. So they had more employees. But which one, based on that, would have the cheaper premiums? The startup. Why would the startup? That's not the answer, by the way. That's incorrect. So, no, the startup's not the cheaper. You would think, though, they have no, that they haven't had any sickness, haven't had any of this. Nothing is drawn against that
Because
policy. But why?
So
Why would that be wrong?
because nothing's known about that policy.
Nothing is known. There is zero history, right? Okay, so if you have no history, you're not going to take a chance, right? This is how banks do it when they make a loan. Do they make a loan to somebody that has no credit at all? They would almost make a loan to someone who has poor credit than to someone who has no credit, because at least with poor credit, they say, okay, I'm going to charge you 30% interest on this loan because you have poor credit. And that way I can recoup some of my money up front. And then when you do default on your loan, I've at least made some money off of this. The other group has, I don't know what you're going to do. This guy is going to take my money and then never make a payment, right? It's the same thing for insurance. They want to spread the risk across the board, okay? And so what they can do by doing that is say, okay, we have these demographics that we love to insure young people, right? Young people, man, they never go to the doctor. They're invincible until they have some weird late night drinking binge and jump off of some balcony somewhere, right? You laugh. I only speak from experiences, not personal, but from stuff we've seen. It happens. And then they go, that's why car insurance, let's talk about car insurance, the same thing, it's very similar to health insurance, isn't it? Okay, why do you think it's more expensive to insure a 16-year-old male than it is to insure a 16-year-old female? Go ahead, say it.
16-year-old.
Because he's a 16-year-old male, right? I was one. I will tell you what a 16-year-old boy does with an automobile. Everything, okay? Everything. That poor little Honda Civic I owned, it was never the same. I can honestly say there were more than one time that it had all four wheels off the ground. It was awesome, right? But can you imagine trying to insure me, right? Not a good idea. So they offer incentives though, don't they? Insurance companies offer incentives. So think about a 16-year-old boy. What kind of incentive do they offer a 16-year-old boy?
For us, there was good grades.
Good grades, right? Because what have they found out about a student that has good grades? They're more conscientious, right? They're less likely to take risks. And so, therefore, it's not going to cost the insurance company so much money in having to replace a car. They're not going to have to spend money on replacing wheels and fenders and bumpers and things like that, right? That's why your insurance premiums go up when you have a ticket. They look at it as like, wow, you're a risk. So in some ways we look at insurance company and goes, are you kidding me? This is what I pay for. If I get in an accident, you're supposed to pay for it. That's what I'm paying you for. You knew this when you got in business with me, right? That I was gonna drive fast. You knew that I was gonna run into somebody. Right? That's how we look at it. But they're looking at it like, no, this is our money. But then you go, I pay you this much money a month. Least you can do is not go up on my premium since I haven't had an accident in 8 years. I'll say that and I'll go out here tonight and we'll have had something happen, right? Donut parking lot. I'm sitting in the Krispy Kreme and I'll back into somebody. So I had that happen to me 2 years ago. I was pulling out of Walgreens, pulling through the parking lot and somebody wasn't paying attention. They backed right into the side of my car. So yeah, I was kind of bummed about that. So but all these things increase the risk. So can you imagine reducing your pool, okay? And then you find out that you've got a bunch of skydivers in the group, right? Your life insurance provider. And you have a pool of only 25 people that you're trying to insure. And all of these people want $1 million life insurance policies. And they go skydiving twice a week. Okay? Those are questions on your life insurance policy if you go above a certain level. Pretty interesting though, right? It's a really kind of like playing the stock market or going to Vegas in a lot of ways for these insurance companies. They look at it like, hey.
Will they let you just go to any level that you want to for life insurance? Or do you have to like maybe meet certain income?
You could go get $1 million policy today. But you have to be willing to pay the premium on it. And your premium will be cheaper than my premium because here I am, a 43-year-old man, and I'm supposedly closer to kicking the bucket, right? Okay. So they're gonna look at it like, 43-year-old guy. Well, he doesn't smoke, he doesn't drink, he doesn't do any of this stuff. But what are his labs like? They'll start out, you get above a certain premium, right? You get above a certain payout, and they go, okay, what's his health like? How often does he exercise? We want to know his blood pressure. Things like that. They start asking, the first time you have to go for a physical for your insurance, you think, seriously? And then you realize they're just establishing their risk, okay? All right.
Trying to get $1 million.
Yeah, get you $1 million policy.
They're gonna love me. He sits at home, doesn't do anything.
Yeah.
$2 a month.
That's $2 a month. You'd be surprised when you get for $10 a month, though, when you're young. There's a lot of stuff out there. And the hard one is when you're a parent and they offer those life insurance policies for your kids, and you're like, I don't even like thinking about this, Why, you want me to insure my kid? And then you see you can get you feel weird, you're like, okay, I got a $20,000 insurance policy that'll, I hate to say it, cover a funeral for a kid. To cover a funeral, things like that, and then, but it's only $1.75 a month.
Really?
Yeah, I probably need to do that. What's that?
It's $1.75.
$1.75, yeah.
I have 6 weeks.
Because the risk of having a 14-year-old die is really low.
Oh,
right?
you have not seen Type Challenge. It's high now.
Dreams could have lots of kids.
So,
It's high. It's serious. Kids are very stupid.
okay, so any other questions on that? Okay, so 4 fundamental principles behind this is it's unpredictable, okay, for the insured. Okay? Okay, and it can be predicted. These underwriters are really smart. They have lots of these really awesome algorithms. They run you through based on your demographic, and they say, yeah, you're going to live to be 72. 7 months and 3 days. No, I'm kidding. It's not that accurate, but it's they can pretty much figure out a general idea of where when you're going to become a risk for them, at what age you're going to develop, become a health risk. And so we already talked about how it transfers from the individual to the group, right? Because we get more people in the pool, spread that number across everybody, everybody's happy, right? Because it's better for a group to pay $35 a month a person than an individual to pay $110 a month, right? It'd be a lot easier. I wish it was that cheap. I'm just throwing numbers out there. Do not go looking for that policy. Okay? But they share losses. So what happens if I have mass casualty and all these people are covered? Then what happens is insurance goes up for the whole group. So if you look, you'll notice every year it seems like your insurance rates will go up, and you're like, why are my insurance rates going up? And then you'll see that, okay, well there have been some pretty substantial events in this year, and cost of healthcare has gone up, the cost of everything has gone up, and so they're just trying to spread that out. So you start thinking, man, my insurance company, I'm paying all this to them, and I haven't been sick in 3 years. Maybe I'll drop my coverage. And so you drop your coverage. And then, of course, that's the year that you need the coverage, right? All right. So rating risk is based on a group's own claims. I talked to you about the history of the group in Arkansas, had no history. It was really expensive. In fact, they came to me. It's funny because they thought, since they split off of this other company, they thought that they would be able to kind of tag on and be able to establish similar rates as the other company. And so after 3 months with the company, they came to me and they said, hey, we miscalculated what your insurance is going to cost. And so instead of, I think at the time I was paying around $280 a month for the family, they increased it to over $700 a month. And I'm like, I can get a private plan cheaper than that, just run a high deductible plan or something and get my own insurance. So I said to him, I said, look, that's ridiculous. I said, I'm forking over another $6,000 a year just to the insurance. And I said, I'm not going to do that. I'll start looking for another job. If that's the case, I can go somewhere else and get better benefits. And so they came back to me and said, we're just going to cover that for you. So the company ate it. They ate $6,000 a year because they thought, well, it's cheaper to pay the $6,000 than it is to go find a new administrator. So sometimes you can play with the company a little bit. Anyway, community rating, right? It says it does not consider demographics. Garbage. Okay. The community rating is not based on your demographic, though. They just look at the community. Okay. Adjusted community rating does look at it, so I'm wrong. It is garbage, though. They all look at demographics at some point. Just remember, community rating does not look at demographics, because if that's on the exam, I don't want you missing that because you said, Mr. Youngblood said that demographics are considered in everything. Community rating, they don't consider demographics. That's the adult things they do. Okay. All right. Okay. What are deductibles? You guys are totally confused, right?
I missed that question.
If you missed that question.
So is it like a wink wink?
It's a wink wink
Okay.
thing, yeah. But community ratings,
So they
no
don't
demographics, okay? They look at the experience of the population. An experience rating is just on the group's own claims. I know, we all want to be out there, don't we?
Yes.
I know. What slide are we on?
Can we just take our
14.
laptops outside?
I wish. We're moving along pretty well. We'll get through this, don't worry. We have lots of picture slides. We don't have to spend much time on this. What are deductibles?
You pay every month.
What you pay every month, right? Actually, that's your premium.
Oh, that's
Yeah.
your premium.
Oh, that's what you
Okay.
like.
You have me
What you have
covered.
to pay.
I was like,
Yeah.
So if you have an
Sorry.
incident, the deductible is how much you're invested.
Yeah.
So they spread the risk over to you, right?
I was like,
This is how they reduce the level of moral hazard here. They go, okay, we're going to make you pay something so that you're not going to the doctor every time. So you go to the doctor every time, right? And they say, this is the procedure you're having done. The deductible for this procedure is this much month. I don't know what I'm talking about. So you'll have a deductible. You have to meet every year, okay? Usually that's a yearly deductible. So you go in for procedure and they say this type of procedure requires this type of deductible. Does that make sense? You may have a plan that has a basic deductible, just a general deductible that you have to meet every year. Some of those are high deductible plans where you're like, okay, you got a $10,000 deductible. That's what some of these high deductible plans are. You have to pay $10,000 before insurance will even kick in at that rate. Yeah. And those are the ones that go into the ER and say, I don't have insurance. Just help me. Because they know that's only, and they'll send it out and yeah. Okay.
Also, they'll say they won't have insurance and then,
Because then you don't have to show your insurance card.
are there a lot of people that wait till like the start of the year, get their tax refund, and then just get their deductible out of the way?
I don't know.
Like get all their services?
I know that, like, for example, I know people that have had, for example, knee replacements. And they're like, okay, I had a knee replacement in June. And so I met my deductible for the year, and I know that I'm going to need this other procedure done. And so they go to their doc and say, I know I need this procedure. Can we do it before the end of the year? Because that way next year I don't have to come up with another. Usually it's like a $1,500 deductible or something. So remember this, okay? Not to be confused with co-payments, but some deductibles are based on the types of things that you do. So for example, it's like your car insurance. You may have a $250 deductible, but if you have an uninsured motorist hit you, it may be a $500 deductible for uninsured motorists, okay? It's the same thing with healthcare. Depending on what you're having done, you may have to have a different threshold to breach for your deductible. Make sense? Co-payment, on the other hand, is also how they spread the risk and avoid they give you a lower moral hazard, right? If you know that you have to pay $30 every time you go to the physician, every time, then you're probably not going to go 5 times a week, right? $150 a week, $600 a month. I can do a lot with $600 a month, So it just depends on your plan, how much your co-payment is, right? Some people don't have a co-payment. Some of those Cadillac plans have 0 co-payment, which is awesome. You just go to the doc and they take care of you. Some of them, for example, like the plan that I have, it's $25 a pop, $50 if I go to the ER. And so what does that tell you? They don't want me to go to the emergency room for a cold, right? Or the flu, unless it's really, really bad. They usually say $50 here, $25 here. But if you go in for your annual physical, it's a wellness visit, $0, right? Those are pretty good. So those are how co-payments work. Confusion. Everybody knows the difference between a co-payment and a deductible, right? Okay. Co-insurance. What's this? Is it deductible? Kinda, right? They're gonna. It's all the time, yeah. So 80%. Okay, up to a certain percentage usually. They usually will say, 80% for the first $10,000, and then after that we cover everything. Or it could be the other way. We'll only cover you 80% for, $50,000, and after that you don't have any coverage at all. There are plans like that out there. Okay. It depends on your coverage. So an 80-20 plan, they usually have a maximum limit though. Which one? So what's indemnity plan? If you have questions, it's on the board. How's that different from service plan? Let's just put it that way. Key word there is you, okay? A lot of these indemnity plans require you to go into the doc, you pay the bill, and they say, here you go. We pay you back for your bill, okay? Okay, and you can go to anybody.
Yes.
You can go to anyone. Okay, so basically everybody knows about in-network, out-of-network. These have no network. It's just like, okay, you pick them, we'll pay you back for them. You know how rare these are? They're very rare nowadays. Most physicians are associated with some health insurances, and so you're in plan, and so they know what they can bill for, know what they can't bill for. That's kind of like when I had my ankle surgery, I told you about, and I talked to my buddy Claire, and I'm like, you know, he did the x-ray, and then he said, hey, let me run your insurance, see what it'll pay for. Oh yeah, it'll cover all your MRI, so let me just send you for an MRI. So I was in network. He was in network. And then found out that his place he did the surgery was out of network. Yeah, it's an expensive mistake for them. So, all right. So service plans are those that have network affiliation. Okay. I'm going crazy because I don't have the battery's dead on my little clicker. I'm stuck behind this here. So, all right. So I'm going to show you different status U.S. insurance coverage for U.S. in 2015. So look at that. 49% is employer base, and if you include the individual plans in there, there's all this private stuff. 56%. Medicare, Medicaid, and other public, 36%. So, I mean, that's a substantial portion of the United States covered. But you got 9% uninsured. So, 9%. So what are some of the things they tried to do that they've tried in the past to kind of cover that 9%? So expand Medicaid, yeah. They also tried to say, we're gonna give you the individual mandate, right? I'll show you a slide here in a minute, it's kind of funny. Makes me laugh because I'll tell you about it in a minute, it's pretty funny. But private insurance, it is called voluntary health insurance, right? Why is it voluntary health insurance? We're the only country in the world, by the way, that when it comes to private insurance, we call it voluntary. Because it's voluntary, right? We're in a voluntary system. You don't have to do it. No, it's really not rocket science, right? Voluntary service, because it's voluntary. Yeah. And then there's a lot of businesses that are self-insured. How do they do that? How do you become self-insured? Do they just say, oh yeah, we're our own insurance company?
They have a large enough pool.
Yeah, they have deep pockets, basically. And they say, okay, we've looked at the risk on this. We've established ourselves as our own insurance. We cover our own people. So that's pretty incredible. It's a really remarkable plan. I know lots of churches do this. They're self-insured. Yeah. So lots of big churches do this. How's that? Is that better? You're like, my church is poor. Did you just say that? I'm sorry. So
It's okay.
that's why your pastor's up there every week. Listen, we need a little more here. Yeah. So increase your tithes to 12%. So, sorry. I'm not trying to make fun of anybody's church. Don't take it that way. All right, but self-insurance is a real thing, right? So think about that, okay? So let's talk about types of insurance. We got group insurance. What's group insurance?
Buy it for a group of people, more than one.
That's a group, right? Yeah, it's a group. So what about self-insurance?
So pay for yourself.
Yeah, you're paying for it yourself. That's why I'm telling you, if you get these wrong, I'm going to be really upset. What about individual private insurance? I bought it myself through another organization, though, right? I am not furnishing my own insurance. I didn't say, hey, this is the Ryan Youngblood insurance plan, right? This is something I go and purchase from a provider, okay? High deductible plans, those are getting bigger now. And those are, people are, so these high deductible plans is really funny. This is kind of like what I call a double risk evaluation, because the high deductible plans are plans that people say, okay, we can insure anybody underneath these. So you have this larger pool of people who may or may not be sick. And then you have the person does their own self-assessment and they say, okay, I'm evaluating my own risk here. How likely is it that I'm going to need major catastrophic help? And that's all this is for catastrophic help. You know, it's like, okay, I hit 10 grand, I can probably absorb 10 grand. I can't, but you may be able to absorb 10 grand, right? In your yearly insurance expenses. But I'm looking at you and giving you the total benefit of the doubt. I look out there and I'm like, look at all these wealthy students. I'm kidding.
If I was a wealthy student, I wouldn't be here.
Yeah.
Yeah.
If I was a wealthy person, I wouldn't be here. I'm working 2 jobs, got it? I mean, come on. I do this actually because I really like it. If you saw how much adjunct professors get paid, you'd laugh. So,
Yeah.
you really would. You really would.
I've seen before.
So, but they do a self-assessment and they say, okay, I'm going to be able to afford this, or maybe not, and I will really think hard if I get sick. Those are the ones that say, I gotta, I think it's just the flu. I'll be okay.
The death rates this year.
Yeah, the death rates this year are ridiculous, aren't they? You're talking people that you would never think dying, 35 to 45-year-olds. They wait till it's too late. They go to the doc and they think, can you help me? Nope, can't. I'm going to try, but.
Or they can't afford the medicine.
Or they can't afford the medicine. Yeah, because, Tamiflu is expensive,
There's
right?
that teacher in Texas who she died because she couldn't afford the test.
Yeah, and that's, I have total ethical problems with these types of things, okay? It's really hard for me to think about that kind of stuff, because it's, yeah.
It's all about the money.
Yeah, in a lot of the ways it is, but I look at it from both sides and I go, okay, now you gotta make money to stay open, right? And who's gonna pay that? And then you start thinking about, who in here, by the way, okay, who in here wants to pay more in taxes? Man, it's silent. Nobody ever raises their hand and says, I do, right? Nobody does. Yeah, we don't like to pay taxes. And we're talking, if you go to a national health insurance, your tax rates are really high. They just are. It's a fact, okay? There's no magic bullet here, got it? There's nothing that's going to quick fix any of this, all right? And to be honest, there's no one plan that's perfect. There's not. I will tell you, I look at some of the politics that have inserted into this, and it's almost laughable, because that's what this has become about. It's become about politics and power, in my opinion, more than anything else. We could fix the problem, but we won't get our darn egos out of the way. That's really what I think. So, I can insert opinion occasionally, right? I ask for your opinions, and by the way, going back to the exams, if it asks for an opinion, give an opinion. You're not going to be penalized for an opinion unless you don't give an opinion, okay? And it's really hard to decipher an opinion when you mingle an opinion in there and you don't say, well, I think. If you don't say I in this, it's hard to see it's your opinion, okay? Just a heads up, okay? All right. Everybody's like, oh my gosh, my exam's hosed. I must have really screwed that exam up. You're okay. Anyway, so just think about that, all right? There's a lot of problems with our healthcare system. None of them are really easily fixed. All right, managed care organizations. This is the majority of what we use, right? I have a PPO. I love it. I can pick any physician. I don't have to go to my primary care and then get a referral. I don't. Now he can give me a referral, but I don't need it. If I want to go straight to an orthopedic surgeon and have him look at my leg, I can do it. There's no gatekeeper with a PPO. I love that about it. Now an HMO is different. They require a gatekeeper, okay? So is one plan better than the other? Well, it's better for the insurance company in a lot of ways, because we talk about specialization, right? You go to a specialist and they automatically want to do something that's regarding, fits in with their specialization. So I have a really rare disease, okay? True story. I don't divulge it very often, but I have a very, very rare form of a scleroderma. And so I get these little scars on my face, like you see that little round. Somebody asked me what that was and what the little thing on my forehead is. It's like, yeah, bar fight, no big deal, you know. No, it's just a really rare form, right? So I went to my primary care and he's like, I have no idea what that is. I thought that he literally offered up the idea that it was a bar fight. That's where I came up with that. So he's like, I have no idea what that is. And so he's like, you know what, maybe we should send you over and have you checked out. Sends me over to a dermatologist, they check it out. The guy walks in the room, he's like, I know, he was giddy. I'm the only person in the Tri-Cities with this form of scleroderma. He was so excited. He called his friend, a guy he went to medical school with, who works at the Mayo Clinic. True story. And he says, so how many cases of Incuba sabra have you seen in your career? He goes, in textbooks or in person? He said in person. He goes, never. He goes, I've got one right now, like I was a collector's item. So I walk in, I see the guy, he high fives me, how you doing? Takes a few measurements, see if they're getting worse. And he says, all right, I'll see you in 6 weeks. And I get checked every 6 to 8 weeks, and life's good, you know. But I didn't have to have a gatekeeper for that. My plan would have allowed me to go straight to him if I thought about it. So there are pros and cons, okay? Now the specialist, that's why I'm a proponent of being able to see a specialist, because he knew exactly what it was as soon as he saw it. That's pretty awesome, right? Because what does he do? He looks at this stuff all the time. He knows exactly what it is. It's awesome. I love specialists. Let him keep being a specialist. And when he figured it out, we got it under control. I've had zero growth since he started a treatment. So, you know, I told my wife, I said, you know, I'm like Two-Face because it's only on one side of my face. And so I'm like, yeah. At first I was like, well, take a good look because you're not going to be able to see this beautiful face the rest of your life. It's going to be some rough stuff. And now he stopped it. So, hey, you know, she might get to look at it for a little longer. So. But I'm so happy. I really am. I love the guy. He has become a godsend in many ways because this could have progressed really bad. I'll give you a little background. I know you guys are like, I'm so sick of the tangents today, Youngblood, but it will embed into the bone and shrinks the bone. And so as it shrinks, the one that we're worried about was the one on the forehead, obviously, because if it shrinks the bone, it puts pressure on the frontal lobe. And you can imagine me with worse personality disorders than I already have, right? And would be a result. So you know, to get it under control was pretty awesome. And it's because I had a specialist who knew what he was doing. My primary care had no clue. And I had no problem getting into a specialist because of it. So it's pretty awesome. All right. Let's see. Public financing. So let's just dig into some of those here in a little bit. Hang on. We got some exciting stuff ahead of us. So we'll get into Medicare, Medicaid, PACE, CHIP, the VA, and Indian Health here in a second. I've got slides all about these, okay? So we'll skip over that. All right, high deductible health plans. Some people look at them as a savings option because it reduces their premium, right? Short-term stopgap coverage. Everybody heard of COBRA? So basically what happened is you ended up with these COBRA plans. So when you lose your job at work, you're eligible for a COBRA plan where between now and when you find another job, you can maintain your health coverage at a higher rate. It goes up. It does. Your expense does go up.
Wow. I don't get the insurance. This COBRA costs more than the normal insurance.
Yeah, it does.
But you're unemployed.
You are not employed, correct?
So you pay back after?
No, you pay it immediately. You got to keep up with the monthly premium. So basically what happens is the company says to you, hey, if you want to maintain your insurance, you just pick up from here on. Now usually, initially, there is a cheaper rate for a certain period of time, but at a certain point, that COBRA plan is all yours, okay? It's all yours. So when I lost my job back 10, 12 years ago, they did that company-wide layoff, and they said, okay, based on seniority, we're going to give you this much severance pay. We'll cover your insurance until the end of your severance. I've been there for 7 years. I've been there longer than everybody but one person. So I had a really good severance package. But some of those people only been there for a year. And so they ended up with having only a certain amount of coverage, and then they had to kick into a COBRA plan. As soon as my my severance was up, I dropped the insurance. I was not going to pay a COBRA plan. It would be cheaper for me to get a high deductible plan than to pay for the COBRA plan because I had a really good plan. And you think about, well, let me see when we're going to talk about fringe. In a couple slides. So I'll give you the details of why it's so expensive, okay, in just a minute. So Medigap, this is something that I want you to read about in the Medicare handbook, okay? I want to say page, I'm not even going to try to guess. It's on the slide. You'll see the page, okay? So the pay or play mandate, what was this? What does this refer to? So it's the individual mandate, yeah. So what has happened to the individual mandate? The tax bill came through last year, right? And they said, we're going to do away with individual mandate. So now what happens with insurance plans, especially those that are involved on the exchange? What happens to those premiums, you think?
They go up.
Shoot up, right? Yeah. And why is that? Because people say, I don't want to play, right? And I'm willing to pay, right? Now there's no pay. They don't have to play and they don't have to pay, right? Before they said, okay, if you don't participate, you have to pay a penalty, right? And people were doing the risk assessment on that. Okay, what's the penalty per year? I can afford that. That's cheaper. And I can just go to the ER and get treatment if it's bad enough, you know? And so our ERs stay full. It's pretty scary. Premium cost and employment-based plans. So you have a premium, right? Are you paying the full premium, or is your employer paying a portion of that? A lot of times your employer pays a portion, right? Cost sharing through utilization. Okay, so let's look at this. This table here is pretty interesting. If you look at 2005 to 2010, you'll see that there was pretty good size increases across the board, with the exception of those that had greater than 200 workers, okay, on the percentage of covered workers. Now, if you look at the total number of percentage-wise of employers offering health insurance, this is the section I want you to think about. So look at 2010, everything, so let's look at a company with 25 to 49. So you had 92% of employers covered their employees. Those that had greater than 200, 99%. Okay, what's a reason that these larger employers that employ more people, why would their percentages be higher?
Because the premiums are gonna be lower.
Yeah, they have a larger pool, their premiums are gonna be lower, and in order to attract people, they're going to offer health insurance because it's a fringe benefit, okay? And in 2010, the mandate came out that said if you have more than this many people, you're going to have coverage. Well, look at what happened in 2015. Look at these numbers. Those that had 25 to 49, they dropped by 10%. And I will tell you, those that have greater than 200 workers, a 1% drop is pretty dramatic. Okay. So these that had fewer than 200 workers, look at how those numbers drop. You're looking at 59 to 47, 76 to 63. That's 13%. 92 to 82. That's pretty drastic, right? So if you have this drastic, what do you think happened here?
A lot of people lost coverage for the amount of time.
Okay, so why do you think employers opted not to offer coverage?
Might have been more expensive.
Yeah.
Or they just were like, oh, well, we don't have to do it, so.
Yeah, so it's more expensive. Okay, so here's what happened with us, okay? I'm in an organization that has less than 200 workers. Our premiums are high already. And we looked at it and saw how much money we were paying in fringe out for our portion to supply insurance to our employees. And we determined that it was cheaper to pay the penalty than it was to pay for the insurance. The government knew this going in, that there would be those who looked at it and says it's cheaper to pay the penalty. And so from a cost analysis, I look at it and go, okay, if it's cheaper for me not to provide insurance for my employees than it is to provide, and I can pay, and I know what my fixed rate will be every year for my penalty, I can go ahead and budget for that. I don't have to worry about turnover. Because remember, most plans, when you're a small company and you're providing insurance for your people, you have to pay the premium upfront. Now you get reimbursed when the plan is canceled up to a certain percentage, but you usually lose money. So every time you hire a person and fire a person, or that person quits, you're out a certain percentage of money. So you're looking at this and you're going, okay, now it's cheaper for me just to pay the penalty, and I can just go ahead and put that on my balance sheet as a known cost for my organization. And the government's like, yeah, send us your money. We'll take it. And that's why, in my opinion, when they incorporated it into a tax, when they incorporated this through the IRS, it became a problem for me. Because it made this there was way too many hands involved in this, and companies were like, I'm just gonna opt out because I don't have to worry about all this red tape and just take care of it. Imagine having to keep up with every employee, keep maintaining a certain percentage of your employees insured, and then, you know, having to report to the federal government what your insurance plan was. It's a lot of red tape, okay? It's not so simple as just saying, okay, well, we're covering our employees. It's a lot of red tape. Talking about organizational structure changes just because of premiums, and just from the provider standpoint of providing insurance for my employees becomes a nightmare, okay? So that's a cost. It required me to change structure of my organization. Seems cold-hearted, right? Can you imagine being the poor employee who's always had insurance, and then you tell them, we're not going to provide you insurance? So what happens with those employees? They go somewhere else, right? We got a healthcare shortage. So they go somewhere else. Like, well, I'll just go find another job somewhere else. So I end up looking at this and going, okay, well, I have to increase my hourly pay for my employees. It's still cheaper for me to increase their wages to attract people to come to work here so they can pay for their own healthcare. Sticky, isn't it? It's a mess. But that's the realistic side of this, okay? All right. There are 6 main ACA provisions, and I know you're gonna love these, okay? Okay, so they said that we were gonna be required to enroll young adults until 26 under the parents plan. I have no problems with that. I think that most young adults are either in college, and you know, their mom and dad to some extent are helping out, you know, in some way. Unless you were me and you just said, I'm out of here, I'm on my own. Which was crazy, by the way, to think about. Gosh, man, are you kidding? My mom's a great cook, you know, I missed that. What was I thinking? They made it illegal to charge more or refuse coverage for pre-existing conditions. Also great, but what happens when you do this? What happens to your risk pool? All of a sudden you're including a bunch of people that have all these pre-existing conditions. What happens? Their costs go up, right? And so automatic premiums shot up. Not the only reason, but a definite reason for it, okay? All health plans had to include certain essential health benefits. Also great. Okay, so it became really, a lot of things became this proactive wellness. They were worried about keeping you healthy, so you didn't have to go to the doctor, right? That's why my plan changed, so that every year I could just go to the doc for a checkup, and it didn't cost me, there was no copay. Pretty awesome, I like that. Beyond insurers for the privilege of selling plans with the exchange, right? So this one really came back to bite them. So everybody thought, man, we're gonna have these exchanges in every state, and all these insurers are gonna wanna be on there because you're gonna have these bunch of people who are gonna need insurance, and they're gonna wanna shop those plans. And we'll just charge a fee to those who wanna be involved in the exchanges. This is the United States, people. I'm gonna look at this and go, I already exist. They know I exist. They want to get insured through me. They'll come to me. I don't want to pay to be on some website. Okay, that's not the only reason we had a bunch of people dropping out of this. But yeah, man, you're gonna charge a fee for that? Then there was a Medicare loss ratio. I'm not going to dig into that. I am not going to ask you a question about this on the exam. Okay. And then legal U.S. residents were required to have health insurance or else pay a penalty tax. Okay. Anybody in here like taxes? We already asked that question, right? So everybody hated this aspect of the ACA. So when they got rid of it, nobody screamed except for those who were providing insurance, because now all of a sudden that pool got reduced again, right? So they're having, a lot of these people were healthy young adults. So the deductibles, you got a $10,000 deductible because I was mandated I had to have insurance. I can't afford that, right? And then a lot of your insurers just said, I'm not going to stick around for the ACA exchanges because it's too expensive. Here's a few of these. Okay, these are a few that left. A lot of states, in fact, let's see if I can get this link to show up. This is an interesting map, if it'll pull up. I don't know what I'm doing here. There we go, why not enable all? I'll probably get in trouble with ITS, but see if this map will work. If it doesn't work, when you get home, take a look at it. It's really interesting. It shows from 2014 all the way through 2017 and how each state built up in the number of providers. It's not going to work. With the number of providers, and then all of a sudden they dwindled. All right, never mind then. So, but it's really interesting because a lot of states now only have one provider. Now, some states like New York, they have 12, 13 providers. Iowa has one provider that's affiliated with the exchange. I want to say, I don't want to be misquoted, so I'm not going to say it. But there was there was one state that was at risk of not having any providers at all, and so the federal government said, "Hey, we'll cut you a break if you'll get involved with this exchange." And so they cut them a huge break just so they would have one insurance company on their marketplace. But what does that do for a consumer? So say the only place you could ever go to purchase food is Walmart. I would probably shoot myself. Not a big fan of Walmart. And the only type of ketchup at Walmart was the Walmart brand. Yeah, now we're talking, right? But that's all you got, right? And it's the only place you could ever shop for ketchup.
Great value.
So think about that. But they offer it in different sizes, okay?
Offered in different taste.
So this is a similar scenario to your insurance company. If you only have one insurance provider in a state. Okay. Also, think about it from the other aspect. If you only have one grocery store in your town, who gets all the business? What happens if you bring another grocery store in? Let's talk about gas. That's probably the best analogy here, right? You have a Shell station and a Chevron station right across the street from each other, and the only gas stations in the area. Chevron station drops its prices by 3 cents. What does the Shell station do? They drop theirs, right? What does that do for the consumer?
They start buying.
Yeah, they're like, heck yeah, man, I'm gonna go fill my tank up. Look at that. It's great, right? It's good for the consumer. What does the gas station do to make up for the money? Hey, they might offer a deal on Snickers bars. Sign me up, right? So you go inside, they have a little thing because they know that their markup on their whatever you want to call them, their whatever you call those, I don't even know what they call that, junk food, right? All their junk food's huge, right? So another example is Home Depot. So I supplied to Home Depot for 9 years. 7 years with one company. And we had we supplied cabinet hardware. The markup on some of that cabinet hardware is like 126%. The margins are incredible, okay? And so every now and then Home Depot offers these deals on cabinet hardware. And I'm like, yeah, because Lowe's has similar cabinet hardware. And so everybody starts renovating their homes. Cabinet hardware is an easy way to do it. And Home Depot's like, man, we love cabinet hardware. It's great because we're making a fortune on it. We're paying 17 cents for one handle and we're charging $3.29 for that same handle. That's true story, okay? And so they can sell a saw that costs $180 to make, and they can sell it for $189. In some situations, they could sell a saw for $175 and lose $5 on it because they know they're going to make up for it with the cabinet hardware. So I'd walk into Home Depot's as one of my sales account, and they loved me because they knew I was making them a fortune. Okay, it's the same thing. Okay, it's the same thing in a lot of these exchanges. If you don't have additional, the United States, if you don't have a competing force out there, they pretty much just lock it down. That's kind of like, so one of the concerns with Ballot Health, right, the merger that occurred in the area, what happens to wages? What happens to the cost of healthcare in this area? Is it going to skyrocket? Who are they going to pass this off to? Is there any competitor? They said, well, our competitors are not just in the Tri-Cities area. We also have, Asheville. We have, they name off all these other cities that are within an hour, hour and a half of the market. And that's how they justify it. So is it good or bad? We don't know. We're only a few months in, right? We'll see how this turns out. It could be really good. You think about Mission Health over in Asheville. They're under a COPA. They've survived. They've kept costs down. It's worked out okay. But it required the federal government to get involved and examine their wages. Okay? And do we like the federal government getting involved in our stuff in the United States? Okay, no, nobody does, right? Okay. All right. Let's see. You guys want to take a break?
I need to go to this, I need this course. I need several courses.
Well, you are in this course, so we're going to help you out with this one, okay?
Wait a minute.
Do you want me to give you, I can help you with some Spanish.
Well, you need to teach the course. And I will
10
take
weeks
just that
straight up
course
only
next semester.
Spanish.
So let's talk about PACE really quickly. I'm going to blow through these government plans and these public health insurances, okay? So PACE, 55 years old, nursing home eligible, okay? This is for the elderly. They coordinate medical and social services. And duly eligible, what does it mean to be duly eligible? What programs are they talking about when they talk about dual eligibility?
Medicare.
Medicare, Medicaid, okay? So if you have a duly eligible facility, duly certified facility, they handle both Medicare and Medicaid, okay? So that's really important. Children's Health Insurance Program, part of the Title 21 Social Security Act, uses block grants to states. Okay, easy enough. Let's see what else. They have to be enrolled in Medicaid in order to participate, okay? If you learn the stuff on the slide, you'll be okay, all right? Let's talk about military health service system. Okay, this is the VA, right? Every different branch of the military has their own hospitals, okay? And they use TRICARE. That's what their insurance arm is. So if you have TRICARE, does that mean you only can go to a VA hospital?
No.
No, thank you for being loud and answering that correctly. Yeah, that is correct. TRICARE can go anywhere that insurance is taken, okay? What about workers' compensation? How is that a government program? What does that guarantee?
If you get injured at work, that you will be covered for the injury.
And at no cost to you, right?
Yeah, no.
Yeah, that's the biggest part of that. Remember, you get hurt at work, the company is going to cover you. And another very important part of this is they cannot fire you while you're out because of the injury, okay? Awesome. That's really pretty remarkable perk. You're not going to get replaced on the line. Okay, so the VA is the largest where to go, there we are, an integrated US health system. And you think about that, all of these different VA hospitals, you go into them, you know exactly what established services they have, right? Now, that is why you will not see much of a presence in of VA hospitals in rural areas. It's pretty amazing that Johnson City has a VA hospital. That amazes me. Let's see. Yeah, so the CHAMP VA covers dependents of disabled veterans. Easy enough? Okay, Indian Health Services. You have to remember, while this may be what they consider a federal program, that Indian Health Services consider themselves part of their own country. Okay, so this is the services that federal government supplies, basically, if you want to consider it this way, to another country. Because reservations are not considered part of the United States. Okay, that's why, for example, my brother, my older brother that's in the FBI was in South Dakota for a while. That's why when something happens on the reservation, they don't call the city police department. They have their own police department, their own investigative units, and if it's something very severe, they call the FBI. Okay? And because of that, my brother, he says, I've seen more autopsies than I ever care to see, because they always do an autopsy, seems like. So when there's a murder or any type of strange occurrence, okay? Their facilities are hospital, health centers, school centers, and health stations. Okay, easy enough, right? All right, the big dirty word here, Medicare. One of the most convoluted systems that we maneuver because we want their money, okay? So you have Part A, B, C, and D. You will answer these questions on your own about what's covered and what's not covered. Also outlined right here, see what's covered, see what's not covered, page 59. That's an accurate page number, I promise. I updated this. So what is Part A? It's right there in front of you.
Hospital stays, nursing stays.
Yeah, so when we think of nursing homes, though, we have to remember we're talking about skilled nursing, okay? We're not talking about long-term nursing, okay? This is short stay, okay? And it covers hospital stays. So these are for limited amounts of time. Skilled nursing is exactly what it sounds like, right? It is helping you get healthy based on the skills involved with therapists and nurses, okay? You do not have a heavy physician presence in these locations, okay? Part B is supplemental medical insurance, okay? This is gonna cover things like some therapies, especially in a nursing home, somebody that's on Medicaid gets sick, needs some restorative care, you might be able to bill under Part B. It covers a lot of miscellaneous items, durable medical equipment, things like that, okay? Part C is Medicare Advantage, and then Part D is prescription drug coverage, which is a whole huge ordeal to maneuver through because there's all these different Part D plans, okay? So, Medicaid. How is Medicaid financed? Not very well, right? It's state run, right? And the federal government gives block grants basically and says, okay, we're going to give your state this much to help cover Medicaid. Now, when Affordable Care Act came through, they said you can opt into the new Medicaid programs and payments if you want to meet these requirements. And a lot of states are like, no chance we're doing that. Was Tennessee one of those states that said no chance? Yeah, said no chance. And so because of that, a lot of people that these exchanges would help because people with an income of that's a higher income would have been covered on those. Okay, I am not speaking English today. Those that would have been covered by Medicaid had they expanded it would have had higher incomes. Does that make sense? So it would have covered a higher income bracket. And so those that didn't meet that income in where this was expanded would have made even more money, meaning that they would have probably been able to afford a premium through the exchange a little easier. So when a state didn't buy in, it puts an extra burden on those people, and it put a burden on the state because now you have a lot more uninsured, right? We're talking 9%. That is a very simplistic explanation, okay? You can read on this. Some of you will be able to do your doctoral dissertation on this type of thing because it's so convoluted and there's so much that's unexplored, okay? Maybe I should do that. I should go back and get a PhD, and you could actually call me Dr. Youngblood and it would be legitimate. So, and then I wouldn't be making adjunct pay. Yeah, this is sounding good. Thanks for convincing me of doing that, guys. You guys are great. It's like career counseling with.
My counseling does not come free.
Well, it'll just go on my list of unpaid bills.
We'll build up a town.
Yeah,
Now we gotta spread the risk all the way up.
that's right. We'll just spread that risk around the room, right? Yeah. Just send everybody else a bill for being present.
Right.
Okay. Yeah, that's good enough. Payment functions, third-party payers, okay? So when you have a third-party payer, so what is a third-party payer, first of all? Am I a first-party payer or a second-party payer? I get insurance through my company. Second, yeah. I'm not a primary payer. I'm not self-insured, right? Third-party payer is the insurance company, right? They're the third party. I got my company, I got me, and then I got the insurance company. That's actually doing the payment, okay? And they're the ones that determine the methods and amounts of reimbursement, okay? So they're the ones that say, you only are allowed to get this coverage, and you say, yeah, I'll do that, that's fine. And then when you get sick, you're like, dang, why did I do that? Should have gotten better coverage, right? It was only gonna be an extra $700 a month, piece of cake. So they make these determinations beforehand, okay? And then they don't pay until after you get the service. So think about that. What other business does this? Okay, so restaurants do it, right? You go into a restaurant, you eat food, and then they hand you a check, right? They call it a check. It makes it feel better. And so somebody says, would you like me to go get your bill? Nobody wants to eat there anymore because they feel like, oh yeah, it's bill. It's kind of funny how we play with the English language, right? But restaurants do it. You got to prepay for your gasoline now, right? So that's not one of those that pays for a service after it's rendered. What if you were able to drive your car and then after you use up all the gas, you go back to the gas station and say, oh, here you go, here's your $37 for the gas I used. Nobody does that. You go to Target and you buy a shirt and you wear the shirt out, and then you go, once you've finished using that shirt, it's got all these holes in it, you take it over to Target and they hand you a bill for it. That's what we do with healthcare, right? I go to the hospital, I'm sick, and then once it's all done, then they send me a bill. Okay? And why is it that way? How come they don't charge you up front?
You don't know what's gonna happen.
Exactly. We don't know. It's a human body, right? Anything could happen. We get you in for what we consider a routine service, and you have an adverse reaction to medication they give you, and next thing you know, you're in an intensive care unit. Okay, we don't know. It's the only way to have this play out. But can an insurance company put a hold on that? Can they say, ooh, wait a second, we're not even gonna cover that? They do that all the time, right? They say, we're not even gonna cover that service. So that's why when you go in, you know, for example, at admission at our hospital, we have what we call a physician's pre-admission screening, right? So we run a risk analysis. We look at this and we go, okay, they have this insurance and these are the things that they're sick with. And we know that this sickness normally takes 17 days and then they're home. We call that a RAND. I've used that term so long, I don't even know what it stands for. RAND. And so we look at that length of stay and we say, okay, we can afford to, if we keep them within the RAND, we'll be okay. Because their insurance company has already stated that we can keep them for this long and they'll pay us this much money. And we go, okay, well, good, we can do that. But we keep them 20 days, starts cutting into that bottom line, doesn't it? And so sometimes insurance companies will say to you, no, we will pay for this service, and this service. For example, we'll pay for physical therapy and occupational therapy, but we're not going to pay for speech therapy. Okay? I need speech therapy. Well, what do? When we see that, we may provide speech therapy for free, just because we know that overall that helps us help this patient eat better, they get more nutrients, they get well faster, get them home, okay? And then ultimately, you know, we do okay. So those rates, they will be dictated by the third party, okay? And so a fee schedule is an index of charges. In fact, if you go on to you know how we were talking about RBSs? If you go on to Medicare site, you can pull up an entire fee schedule for the entire United States by zip code. Super exciting reading, but it's all out there. So it's a fee schedule for all the physicians up there. All right, yeah, so we're looking at prospective reimbursement then, right? We look at the DRG and we say, we can make this work and we're gonna get this much money. We will look at their, what we call a CMI, right? Case mix index. We develop a CMI. Patient comes in, we say they're this sick. We rank them on a scale. So normal hospital, I think I talked to you about this before. Normal hospital runs like a 1-3, 1-3-5. You get a patient in, they're 1-6, 1-6-5, and you're thinking, that is a sick patient, okay? CMI is up. Some nursing homes run around a 1.2, 1.3. Some of them get up into 1.4s depending on what they're taking. Let's see. Our CMI at the hospital this morning was a 1.61. So we had a lot of sick patients. And we had let's see, we have 36 beds and we had 32 inpatient this morning at a 1.61, 1.62. It's a lot of sick patients. So sometimes other ways that people get paid is determining DRG. Remember, nursing homes use RUGs, resource utilization groups, and those are ranked. Okay, you have low all the way up to what they call an ultra high. And I think I haven't worked in a nursing home in years, so I'm trying to remember what it is. I think ultra high is 700 minutes plus. It's right there at the limit. So for example, inpatient rehab, the requirement is that a patient gets 3 hours of therapy every day. And so if you total that out, you know, nursing home at an ultra high is just barely approaching that 700 mark, I think. So yeah, there are differences, a lot of these differences in post-acute care. Reimbursement methods here. So fee for service. Sounds exactly like what it is, right? You get paid for a service rendered. But then you got these bundled payments. And these bundled payments become a little more complicated, right? You might have a cardiac bundle. Or there may be, cardiac bundle is probably the big one right now that people talk about, because it's, they say, okay, you have these types of cardiac issues. And it's not just everything to do with the heart. It's just has to do with specifics around the heart. And so if you're part of that bundled payment group and you join in, you network in, I'll show you. I put a couple of links in this to a couple of post-acute things that might be really interesting to you. They're on one of the last slides. But I put the actual PDFs online under week 6. Down at the very bottom, you'll see two links down there. And they talk about a lot of this, dealing with bundles, and one of them especially talks about bundles. So, but bundle charges, I mean, it's what it is. Like I said, it's that bucket of money for doing certain services. Okay, we talked about RVRVSs, lots of different managed care approaches, right? Does Aetna pay the same as Humana? Does, if you're self-insured, you have different policies that you're gonna pay for, right? So all these different methods, I mean, gosh, there's so many approaches. There's as many approaches to payment and reimbursement as there are people, it feels like, right? Cost plus reimbursement, that's really on the physician end. And prospective reimbursement. Prospective reimbursement, if you go into a nursing home, especially, they have what they call a PPS coordinator, prospective payment systems coordinator. So they look at the patient and they say, based on where we are now, we're gonna be able to bill out this much. So we go ahead and submit a bill to Medicare for that. Okay. Let's see, claims processing. So you can have in-house claims processing, a lot of different locations. Depends on your organization, how they handle claims. Just read up a little bit about claims processing. I don't think that we want to spend a lot of time going through all the different ways that you can process claims. But there are specific requirements on how you can process your claims. In fact, part of this has to do with your ability to document. So if you're not documenting correctly, don't meet the federal government standard, no matter what you bill for, they'll deny the payment, okay? So I think I alluded to that a few weeks ago. If you have, for example, in our hospital, we have, so you have an interdisciplinary plan of care, right? And all this is it's watching the patient across the spectrum. So if you have physicians, nurses, therapists, all involved in taking care of a patient to get a patient healthy, their requirement is that they document correctly, okay? And so if they don't sign, for example, the IPOC within 4 days, setting up and establishing goals within 4 days, they miss it by half a day, 3 hours. And we process that claim, federal government audits that claim, and they say, sorry, you didn't meet the minimum requirements. You weren't looking at that patient the way we expect you to look at it. Even though you can look at the documentation and show outside of the IPOC in the documentation of the therapist and all those who did assessments, you show that they all set the goals in another spot. Federal government says, nope. There goes $32,000, for example, okay? No reimbursement for that entire stay. So what does that do to your structure of your organization?
Need to find money somewhere else, clamp down on operations and how people do things.
So you're clamping down on operations, really, right? Because I don't want to look for money somewhere else, because then I have to add extra, what other service are we going to offer? We're going to screw that up too, right? If they're going to mess up the documentation on that. So you spend a lot of time auditing. You develop a quality department that's looking at documentation, making sure that people are documenting correctly. We literally run an active, what we call a live audit on all documentation. So every day we have people looking at stuff that goes in the chart for that day. And if they have, for example, a team conference, or we see that we're 3 days in to a stay and someone hasn't signed off on their IPOC goals, we're gonna email them, email that department and say, where are the goals and who's signing off on this? Get it fixed, because we don't wanna lose money based on a technicality. Technical denials hurt, because the whole process is laborious. I mean, once you get denied, you can appeal, and then they send it back to you and say, no, we're denying your appeal. And then you can appeal again, and then they automatically send you a letter back that says, no, we're gonna deny that appeal. And then you get to appeal again to have it go towards gosh, I'm drawing a blank. It's an ALJ. What does ALJ stand for? Something law judge. Anyway,
Administrative law.
administrative law maybe. I can't remember. I'm drawing a blank. Anyway, so it goes to ALJ level, and so you literally, a judge hears your case about the documentation. You have to explain, this is why we feel like we still need to get paid. That costs a lot of money. All these appeals, that's all hours of people spending. And then once you go to, you think you're gonna send, just your medical records person to court, no, you're gonna have to pay an attorney, right? So it's just money, right? Okay, they have third-party administrators, they have those who step in, they will handle all your billing, they will take care of that processing, they will analyze everything. They are there to do that. Now, fiscal intermediaries and carriers. These are like, for example, the one we use is Cahaba, and they will go back, they hear of complaints, they hear of all these things that could affect us, they do audits, and they may deny you payment. Okay? They're the intermediary between us and Medicare, and they say, okay, we've looked at this and we're denying you payment because we're getting paid by Medicare to find problems. Because they get paid, that's what those RAC audits are. Okay? And I'm not even going to discuss national health expenditures. We have done that so forever, right? But here's a nice little table. Interesting thing about this is if you look at amount per capita and the amount there in billions, it's been relatively, I won't say stable, but if you look at the percentages of its increase, not the percent of GDP, because that changes, but if you look at the percent of increase, it's pretty standard across the board, by percent of increase. The biggest year, it's funny because it goes by 10 years and then they measured in 2015, so it makes it look like it was smaller. Really, it's not that small. So, anybody here? I just want 1 billion. Okay, just so you know, I just want 1 billion. 27. Look at that. 4,198 billion. I just want one.
Just one.
One. I'll split it with you. This is where our money goes. Okay. And I love how they simplify this. They make it sound like, oh yeah, these are the only areas they go, but it's really, really a lot. All right, so here are those 2 links that are not going to open because for some reason the hyperlinks didn't transfer. But these are in. How much time we got? I don't want to lecture for the next 30 minutes. Anybody objecting to that?
Yeah.
Promise me you'll go look at these infographics and email me questions.
I cannot promise that.
Okay, what if I tell you these infographics are going to be on the exam?
I'll look at them.
Okay. They're not. So, let me summarize, right? Financing, it's all about who pays, okay? And what services are gonna be there. And then it affects supply and demand, okay? If you remember that, just think about your own personal finances. If you have money, you'll spend it, right? And you'll find something to spend it on, so you'll find services.
Yeah.
Don't read into that. And it'll produce a need, okay? If you don't have money, you're not gonna use services. It's the difference between going out to dinner and eating ramen noodles, right? Okay, so just think about that way. Same thing applies to healthcare. Only difference is when you have a federal government, they can write their own money and tax whoever they want, it changes the dynamic. So, and this is where everybody in the semester goes, I cannot see where he fits politically. So I'll keep you guessing. So, all right, any questions? All right, thank you guys.